Okay, so Dimple appears to be an astute investor, but there are many other women who we wish would join this, bandwagon as well, because really it's not as difficult as a lot of people perceive it to be. So let's invite two people who are going to help us understand how we can invest in mutual funds. Ashish Shankar, MD and CEO at Motilal Oswal Private Wealth, and Sunaina Dukuna, co-head of fixed income credit at Aditya Birla Sun Life AMC. So Ashish, Sunaina, thank you very much for joining in. Ashish, I want to begin by asking you if investing is really different for men and women. I mean, why is such a big deal being made out of just women investors? Is there something special to it? And also, I was reading this, study which had been done by a fintech company, and they had done it on women investors, and they found that, younger women are more into stocking, what they call stocks, and wealthier women are still into real estate. So where does mutual funds figure?
Sumaira, thank you very much. Always a pleasure to be on your show, and happy to be talking money on the auspicious occasion of Dashera. You're right, Sumaira, that more and more women are coming into the workforce and are thinking about investing, building a portfolio. Traditionally, look, I always believe that women are pretty good with money. I mean, anybody who can run a household budget, right, has to understand, expenses as well as savings. Traditionally, yes, there has always been the inclination towards investment avenues like gold, real estate. But increasingly, what we are seeing is with more women in the workforce, younger women, managing their finances independently. The other trend, Sumera, I also see is that more and more, I think wealthy families the husbands are involving their partners when it comes to investing decisions. So there are two things that I feel are critical. One is I think women also need to spend more time understanding different investment choices, and mutual funds are the easiest vehicle to invest. I mean, one misconception that I wanted to clarify is normally people think mutual funds are related to markets and they're risky per se. I just wanted to clarify this concept that mutual funds are just a vehicle. I mean, depending on where you need to take exposure, whether it's fixed income, whether it is equities, even, now even gold is available in the mutual fund format. So mutual funds is a vehicle, is the most convenient, easiest, the most liquid, the most tax efficient vehicle. So anybody who's beginning their investment journey, I think mutual fund should be the first port of call. So that's what I feel.
Okay, fair enough. There was a Crystal Foundation study as well, which I was reading, which shows that, women tend to be more goal-oriented, which is a good thing. But they said the goals appear to be very short-term, fixing a part of the house, somebody's wedding, so on and so forth. It's not really that long-term wealth creation. Sunaina, is that something which is a detriment to investing in mutual funds?
So hi, Sumaira. Thanks so much for having me on your show to start with. I've actually seen quite a few studies on this topic which have very divergent views. So while you mentioned this Crystal Foundation study that talks about the short-term goal orientation of women, I've actually seen a couple of studies which mention that women prefer to invest for the long term, but are actually very passive about it, which means they don't like to actually trade in and trade out. I personally believe that, women have various goals. Some of them are short term, buying that exquisite piece of jewelry that you've got your eye on, or making those travel plans. But I also believe that, women do plan long term as well. My husband and I are planning for our child's higher education. And, my kid is just 6 years old. So that's very long-term planning that you could actually say we're doing. But women do plan for, their dream house, for their retirement, etc. So it's a combination of short-term goals and long-term goals. Maybe where it's slightly different, I think, is that women should also plan an emergency fund because, they should ensure that their savings can see them through for a longer period of time, just in case there could be a possibility of, a break in earnings because of, let's say, childcare or taking care of aged parents. But as far as mutual funds are concerned, there are actually quite and investing in mutual funds, irrespective of your goals, whether it's short term or long term, is actually quite a large array of mutual funds available. You have 16 categories of debt funds. You have 11 categories of equity, and not to forget 6 of hybrid. So I think a portfolio can be built based on the goals, based on the timeline to the goals, and then you can optimize using all these available avenues and get an optimum asset allocation.
Well, short-term or long-term in terms of the goal, but I have any number of people telling me that, women's portfolios have performed better with a lower amount of risk taken. So that's what works in the end, right? Ashish, in theory, and, like you alluded to also saying that mutual funds are simpler. It should be the first port of call, and I agree. The only stumbling block which seems to be is that, once I've decided I'm going to invest in mutual funds, I open my screen and I see close to 2,000 schemes, and that's when people start getting overwhelmed, right? Is there a way to sort of narrow down the selection? You don't want to do, ask somebody, koi scheme bata de. You also don't want to have to, you don't know how to choose between 2,000 schemes. So what do you do?
Yes, absolutely. The information overload is really confusing. There is so much information available now through media platforms, through tech platforms, and there is such diversity of views. But just to simplify things, I just wanted to clarify that, look, mutual funds, as I mentioned, are vehicles to get exposure in any of the asset classes that you want to invest in. So broadly, there are 4 asset classes. There is a growth asset class, which is equities. There is an income asset class, which is fixed income. There is a liquid asset class, and Sunaina alluded to the fact that even women should build an emergency fund, so that could be in liquid. And then there is an insurance asset class, which is nothing but gold. So underlying, there are only 4 asset classes. Now, to take exposure in these 4 asset classes, there are different funds. Now, to cut the clutter, if one can just have maybe 3 or 4, let's say what we call flexi cap mutual funds, which can go anywhere, with good quality fund managers. Similarly, in fixed income, there are something called these roll down strategies, these target maturity strategies, right? So you invest for 3 years and, the portfolio gets built accordingly. So I think it's important that when, women start their investing journey, they should try and keep things as simple as possible. And I strongly encourage women to also consult with some financial advisor who can guide them through this journey. And I just wanted to make one point, Sumaira, that you alluded to, that women portfolios have done extremely well. I'm much better than men, but I'm not surprised, because I always believe that, 80% of investing is EQ and 20% is IQ. And I believe women have superior EQs than men. So, and I agree with Sunaina that women can plan really, really long term. And that is something that, I think it comes naturally to them.
All right. So, yeah, there's +2 for you right here. Okay, we're going to take a very quick break, and Ashish and Sunaina are going to stay with us. We have a lot more to talk about: how you get started with the journey in mutual funds and how do you stay with it. Stay tuned. We'll be right back. Hi, welcome back to Financial Quotient. We're in conversation with Ashish Shankar, MD and CEO of Motilal Oswal Private Wealth, and Sunaina Dukuna, co-head of fixed income credit at Aditya Birla Sun Life AMC. So we've spoken a little bit about, how you go about investing in mutual funds. But Sunaina, speaking specifically of debt funds, they used to be favorites of risk-averse, or rather what some people prefer to call risk-aware investors. But now, even they seem to be taking, a cautious approach. Plus, you have the fact that returns are far from attractive, in this current environment. So, do debt funds still deserve a place in portfolios, and which categories?
So, Sumaira, firstly, I think attractive returns need to be seen in need to be contextualized based on the prevailing macroeconomic environment. So, what does that actually mean? For the last 25 years, our inflation in India has actually averaged at around about 6%. And the repo rate has averaged between 6 and 6.5%. Now, if we look at it where we are today, our view is that over the next 3 to 5 years, inflation is going to average at around about 5 to 5.5%, but it's going to be, a long time, at least 3 or 4 years, till we see that repo rate regain that 6% level. So it actually means that we're in a period of very low real yields. And that's something we've seen globally. In fact, you have negative real rates, in some developed countries. World over, we've entered a period of financial repression. And that means that the savings of the savers are actually being channelized to borrowers through, incentivizing them with the flush liquidity we have in the markets and the very low interest rates, just to incentivize the borrowers to actually invest so that they can restart or, the economy can restart and regrow all over again. So I think with this backdrop, we need to reorient our return expectations. So we need to keep that in mind when we're planning our portfolios also. Having said that, you asked, does debt have a place in portfolios? I think, Ashish just, was also mentioning the fact that, you have 4 categories, and 2 very important categories which, would come in the fixed income arena would be, let's say, the liquid part and also the income generating part. In India right now, yield curves are very steep. And that's primarily because the market is factoring a very quick pace of normalization by the RBI. So markets are factoring in 125, 135 basis point hike over the next 1 year, and about a 250 to 275 basis point hike over the next 3 years. Now, while we may believe that that's actually, too quick a pace and RBI likely not to move so quickly, but this very steep yield curve actually provides some amount of a buffer and safety to investors, in a rising interest rate scenario. We always try and tell investors that they should match their investment horizon with the investment duration and the duration of the funds that they choose. At this point of time, given the very steep yield curves, we believe that the 1 to 3 year space is where it's a sweet spot. In terms of debt categories or debt fund categories, it depends on the on the investor. If she's very risk averse, wants to stay to high quality, then categories such as your banking and PSU or your corporate bond fund, your short duration funds, these are the ones that will take advantage of that steepness in the 1 to 3 year space. But if in case your investor is also willing to take on a little bit of credit risk, then credit risk funds also should find a place in portfolios. I think going ahead in the fixed income space, the strategy will be that of yield maximization, because capital gains are clearly well behind us.
Okay. Ashish, I know we're being told over and over again that, don't be obsessed with returns, but what do we do, right? That's what you get at the end of the day. And, at a time when, real rates are negative, real returns are negative, what do you do? I mean, is it justified, this obsession with returns?
So, look, first one has to decide how much risk you want to take in your portfolio, right? Clearly, equities is the asset class which can create wealth over a longer period of time, and we've seen that time and time again. So that portion of your savings that you do not require for 5 years, 10 years, or that you're putting aside for certain goals which are far away in terms of time horizon, those should definitely go into equity mutual funds in a gradual manner. Now, as far as selecting equity funds, and I know where you're coming from, I think the most commonly available data is past returns, right? But I always say this, that looking at the past returns and investing is like looking in the rear view mirror and driving a car, right? Invariably, it can lead to accidents. Why do I say that? The reason is we have done some data analytics from 99 till date, and we've done a 3-year rolling return analysis for all the mutual funds available, equity mutual funds available in the market. Now, invariably, what happens is the best performing fund becomes the fund in the last quartile over the subsequent 3 years, and vice versa. So there is a very high degree of mean reversion when it comes to ranking of performance in equity mutual funds. So just looking at the last 3 years returns or 1 year return is a very poor way of making investment decisions. Rather than that, if one were to look at the track record of the fund, I mean, let's say a fund which has minimum 10 years track record, a fund manager who's been doing this for, let's say, 15 years, and a brand that you're comfortable with, right? There are houses which have been in the AMC industry for 10 years, 15 years, 20 years. Select 3 or 4 of them and just stick to those funds. I mean, one of the things that I'd like to point out, Sumaira, is often when people have fresh funds, right? They keep asking us, what is new? What new product can I invest in? Now, my answer is very simple. If you've got 3, 4 equity funds or 2, 3 debt funds that you're comfortable with, you don't need any more new products in your portfolio. Keep investing and increasing exposure in what you have. This is something that I just want to communicate very, very strongly, because everybody keeps coming and asking me, look, I have more money. Is there anything new that I can invest in? See, what is working for you, let it work for you. I think that is important. And keep it simple. Keep it as simple as possible, so that you are focusing more on what creates value for you, whether it's your own profession, work, or any other activity that keeps you going. The investment portfolio, the simpler you keep, the chances are very high that you'll end up in the top quartile in terms of investor returns over a period of time.
Yeah, simple and boring is good, right? Sunena, which are the most important aspects of the MF investing journey for women? Is it selection or diversification? Is it asset allocation, or just a simple act of, staying invested?
So, Sumaira, this is a little bit of a generalization, but I actually believe that women are very cautious investors. They want to do a lot of research before they actually, jump in. And even once they've done the research, they'll cautiously look, wait, keep procrastinating. Maybe now's not the right time. Let's wait for markets to go down, etc., etc. I think the most important thing actually is to start investing early, and keep on investing in a very regular manner. Now, of course, I mean, the other points you mentioned, extremely important as well. You need to build the correct portfolio, keeping in mind your various goals, your risk return profile, and taking help from a financial advisor or a financial planner if required. Could also be looked at. And then keep on monitoring your portfolio. And if required, if it's not really living up to what your initial plan and target is, then maybe recalibrate it as well. And so nowadays it's so easy to do all this, sitting in the comfort of your home, because technology has enabled us to such an extent. Sitting at home, we're able to read, research, articles, blogs. We're able to invest, with just a couple of clicks, redeem your funds. Even your video KYC can happen in a few minutes sitting at home. And even online, you have a lot of these calculators and tools available, a lot of these apps and calculators that help you plan your goals out, be them, child's education or retirement, etc. So it's actually, quite easy nowadays to actually invest. But if you ask me what's the most important thing, I think the most important thing is to actually just start investing.
Yeah, the real risk is not investing, right? Sunena, Ashish, thank you very much to both of you for joining in and, for sort of getting this message across that it's important to stay invested. It's not that difficult, and really, if you need help, then just look for some help, because not investing really is the real risk. So thank you very, very much for joining in. So with that, we're going to wind down on the show, and as we do that, we're going to leave you with one of our women who inspire.